Exactly.
Hey, Meb, try and relax, Meb. I know this is new for you, this whole, podcast, webcast, internet thing. That's how deep you were in the snow in Japan when you were skiing this year, or what? Were you just...
No, this was in Calgary. Last time I came to Calgary, I took this, Toronto. I took this photo. It was like the coldest day of my life. I spent like 28 hours in a row in my hotel room. I brought like t-shirt and shorts. So I need to come back. I was ready to come back this past spring, and sure enough, pandemic hit. So no dice. Actually, for the nerds out there, they should be able to. This is Hoth. This is from the planet Hoth, the Star Wars nerds.
Nice. Awesome to have you. I will remind everybody, as per the usual, anything advice-wise you hear on here is not advice. You should get advice from a licensed practitioner in your neighborhood, or someone you know or don't know for that matter. And we'll talk about all kinds of neat stuff, and we're gonna have some fun. And welcoming Mr. Faber to the Resolve Riffs Thanksgiving edition afternoon, where it's 10 a.m. in your area of the woods. So you're drinking a coffee, I see, but there was a lack of steam coming off the coffee. So I was wondering if it was a Johnny Carson coffee. Anyway, leave that to
two comments. One, my disclaimer is, listeners, you should absolutely listen to my advice, because I give great advice. Don't listen to the Resolve crew. This is a coffee and Bailey's. Just kidding. It's too early here. I have a coffee addiction, and so I'm like a pot of coffee a morning guy. So it's problematic, and I'm trying to adjust. So unlike you guys that put the stick of butter in your coffee, do you guys still do that? That's the most foul thing.
Some of us. What's problematic about it, Meb?
I tried it once and spent the rest of the day having like a film of butter in my. It was just like I just felt nauseous. So
what you're telling me is this is jacked up, Meb, and
yeah.
I can't even imagine pre-coffee Meb then.
Well, I also have a 3-year-old, so I've been up for like 7 hours already now. So this is like the whole circadian rhythms. I'm a night person, man. You guys record this at like 11 p.m. or 1 in the morning, I'd be ready to go. So I have like a coffee alternative. It's like a mushroom mud water. If you've tried it, it's decent. It's pretty good.
Is that the Four Sigmatic or whatever it is from the
same
always talking about?
Umbrella?
Yeah. Do you find it
a different brand?
Do you find it promotes clarity of thought, or what are your?
I always kind of muddle through life in like a dark cloud. I don't know that I ever have this clarity of thought that people talk about. So clearly,
yeah, that's what always comes to my mind when I hear Meb Faber, dark cloud.
Yeah.
The Charlie Brown character walking around in his cloud.
Linus. Yeah, Linus, exactly.
Yeah. Perfect.
So Meb, you were saying that you might be keen to talk about some things that we believe that most other investors don't, or is that?
First of all, does it make sense for us to even introduce Meb at this point? Maybe we just roll into it.
Maybe Meb should introduce us. Like I don't think there's anybody who knows Meb.
That's what I thought. That's right.
Knows us as no Meb, so it's unlikely.
I'll talk about anything. You guys know me. You guys want to talk about Broncos, beers, skiing in Canada? By the way, listeners, if you have any good Black Friday ski deals, I have an empty quiver and plan on doing some skiing this year. So hit me up if you guys see any good deals. I'll talk about anything you guys want to roll with. My only idea was, much like politics and FinTwit on investing, I feel like so many people hold similar beliefs, but what we spend our time arguing about is like that final 10% or 1% or 0.1%. It's fun, and then we should argue about it because that's what we get paid to do, and it matters. But some of the ideas I was looking through, some of these polls we do, and we talk about ideas that the vast majority of the investing space, so let's call it like 75% or more, believe that you guys don't believe. And it's good. I think it's like a mental gymnastics. It's a good exercise to kind of work through, because we've done many of these over the years, and people, you start to see the world from a different perspective, and it's often hard to go back once you kind of open your eyes to a certain perspective. Or you may just say, that's really stupid. I totally disagree with that. Anyway, I thought it'd be a fun jumping off point. Do you guys have anything?
I think that's a great thing. I was just going to say, how do you know that what you're information bubble is providing you with is representative of any large sample size or large enough sample size of the investor community out there. That I think may be the starting point to understand whether or not we're able to even garner that information.
Sure. There's two parts to it. One, I think, is just a little bit of guesstimate common sense. So I'll give you one, and this is not one I want to necessarily argue about, but I don't think there's a more commonly held investment belief. And if you had to poll on Twitter what % believe this, I bet it would be 95, maybe 99%, which is stocks outperform bonds over time. I don't know anyone that doesn't believe that. As it's like the laws of thermodynamics, like that is ironclad. Every single person believes that. You could also do a poll. We've done a bunch of polls over the years that ask people, and obviously my universe will be different than yours, but we get to the point where I think there's a common sense estimate where it's like 80%, 90% of people believe X, Y, Z. So it's a little bit of guesswork, but the ideas that I was kind of thinking about are so different and polarizing that, that you end up on the opposite side. But I agree. You could be in a slightly held bubble of people that like-minded thinking, but usually it's the opposite.
Well, actually, a good example of that, Mike and I were chatting about this. I don't know if it was online or, anyways, over the last few days, someone posted a chart showing the where most investors believe the best opportunity is over the next 5 or 10 years, and at the very top of the list was small value. And I said, here you've got all these investors thinking that they're contrarian, being small value investors. And in reality, is this just a crowded trade? And Mike made the very valid point that what is the chance that this is just preference falsification, right? That this is a survey bias and it actually doesn't reflect where they're actually positioned, or if they are positioned there, it's such a marginal tilt that it's completely meaningless. And so we shouldn't take too much signal from the fact that the survey says X when their actual positioning may be something completely different than X. Might be even like 1 minus X, So I think there is merit in being skeptical about our own assumptions.
Well, I think it's absolutely the point, right? So if everybody gets to the point where they believe stocks outperform bonds, then you would get to the point where assets would be allocated such that stocks may not outperform bonds anymore. And so over what time frame and duration and cycles are those things going to manifest? We were talking last night in our group, and so I won't mention names, but some interesting folks there were talking about the fact that their portfolio had a tilt to small cap value, which had been put in place years and years ago by someone who is no longer on the head of the investment committee anymore. So why are they going to spend time defending the positions of that previous investment committee member? They're no longer there to defend the position. And thus we should just eliminate the small cap value position that's been dragging the portfolio for so long. And so now we run into these complicated dimensions of, the actual rubber hitting the road as with the respect to, well, what are you going to allocate to? How long can you stand allocating to it while it betrays its what's supposed to be some sort of long-term extra risk premium that you're supposed to be harvesting?
This is a perfect example, and you guys have probably heard me make this analogy, but as you think to this stocks versus bonds, being the first law of financial thermodynamics, the second would be inertia. Once someone allocates to something, your brain changes. You have a totally different psychological approach to that investment. And one of the biggest insights that certain marketing people in our world, I think Fisher Investments is a great example of this, have understood is the value of a client. Because once they're there, it could be a separate account, it could be invest in a position. Often the headache of moving, they're there for 10 years, they're there for 20 years, unless something crazy happens. But let me give you an example. So the stocks versus bonds, 99% of people believe that, right? But you ask the same people surveys, how long, and there's survey after survey after survey, and they all say the same thing. And this one is a good example of survey and how people actually allocate, because there's been countless academic papers that demonstrate this too. You make an allocation to an active manager, or you make an allocation to an asset class, small cap value, whatever it may be, even beta, stocks versus bonds. How long do you give that asset class before terminating it or looking for a replacement? And the vast majority, and it's like 80, 90%, it's 3 years and less. And that's the time frame most of these institutions operate on. They do their committees once a year, maybe once a quarter. But year one, it underperforms. Hey, maybe we'll rebalance into it. That wasn't the best timing. Year two, like you're getting some heat, maybe some career risk. Year three, that there's no chance that person is still around. I mean, and so I asked people back when we have cocktail parties. So now we're just drinking mushroom coffee over the internet now. As we talk about this, and I used to talk to people, I say, they'd invariably call me, complain about one of our funds that's doing terrible. Say, Meb, I bought your fund 3 months ago, 6 months ago. Ah, God, it's doing awful. I'm going to give it a little longer, to which I usually respond, man, you ain't seen nothing yet. This could be way, way worse. And they kind of awkwardly smile and they say, okay, fine. How long should I give it? And I say 10 years. They awkwardly laugh, kind of look around, wait for me to say something else. And then I would say, no, I'm serious. Like, this could easily go 3, 5, 10 years underperforming. And now the modern version of 2020, I now say 20 years. And I say this with a completely straight face and a complete total honesty and transparency. And the example I give that totally crushes kind of people's mindset, that's relatively recent. In 2020, US stocks had gone not 3 years, not 5, not 10, 40 years with the same performance as long-term bonds. 4 decades, the most ironclad, universally held belief in all of investing is stocks outperform bonds, 40 years of not outperforming. And then, of course, you can take longer periods back in history of if you go back in the 1900s and 1800s of 60 years. But you can apply that to anything. I mean, my God, gold, small cap value, the Canadian barbell of junior miners and cannabis. I mean, everything, right? It's and that's one. And people hate that reality. They want results now. They want to, allocate and things magically do amazing in the first year. They want that feedback. That's just sadly or happily for the people that can take advantage of it. It's not the way it works.
I was on a panel earlier this week with Dan Rasmussen, and we were chatting backstage afterwards about the Yale model and about Swensen. And Dan was saying he wrote a paper about Swensen a year or two ago, and just sort of highlighting the fact that Swensen's big call in 1984 was to sell bonds and buy stocks. And of course, from 1984 to today, the Sharpe ratio on bonds is 2 to 3 times the Sharpe ratio on stocks. So, I mean, it was actually this strange pro-risk call. He was terrified of inflation and happened to make a big call on stocks when obviously it has been the greatest, most sustainable, most efficient bull market for bonds in the history of markets. And
what's interesting,
just so counterintuitive,
is he followed that call up with the massive change in 2000 from publicly traded stocks to private equity. That he covers it in his books, and you can see it through the Yale endowments allocations. They start expanding rapidly to private equity. That's circa 2000. And they started de-emphasizing U.S. stocks. So he's made a couple extremely lucky, timely, thoughtful, however you want to characterize that, made a couple of those very big calls. And it is interesting that, when you talk to, large family offices, a lot of time they feel as though the Yale endowment model is some sort of, cutting edge philosophy of investing. And it comes back to that sort of talking point that you and I talk about, Adam, which is, okay, well, let's all write down our 3 most favorite, unique, novel strategies that we think are going to outperform over the next 10 years. Let's get out a piece of paper. And obviously the survey will be group dependent on what gets on the paper. But then turn to the person on your left, turn to the person on your right, compare notes. And are you in a crowded trade? Are you in a trade that's done epically well? Like, is it Apple, Google, and Amazon? That's Tesla, and Tesla is my new novel idea. Or is it actually things that are hated, misloved, have had no risk premia for a decade or two, and are very, very difficult to own and to be different from everybody else? Are they on the list? And how likely is that then able to get through the board approval, whichever board it is, whether you're an RIA dealing with retail clients or an institutional manager dealing with an investment board? How long will they operate with subpar returns? Subpar meaning, with whatever benchmark that they've selected as a potential pacing mechanism.
It's a good point, because and it actually is to Meb's theme, highlighting something that we've been chatting about recently, which is that one of the big myths I think that many investors embrace is that they should be modeling their investment policy after the huge institutions, right? The big pension funds and the huge endowments. And I think that is just ultimately incredibly misguided, because the big endowments basically are so large that they have to be the market, right? They can't take any active bets that are sufficiently large enough to make a dent in their return stream. So they end up just being the market, and they try to sort of move outside of public markets into private equity and infrastructure and venture and et cetera. But it ends up just being all tied to pro-cyclical growth. They're all just equity bets of different stripes. And so why would a small investor who has the ability to be agile in their, moving their portfolio around strategically or tactically, but also has flexibility in their mandate? They don't have to look like anybody. There's no committee that's going to review their results in 3 or 5 years and benchmark them against their peer group. They can do whatever they want. They can pursue an absolute mandate or a target return mandate that is very tailored to their specific investment objectives, and they can use all kinds of techniques and take strategic active views in furtherance of that objective that aren't even on the radar of large institutions. So this myth that you should model yourself after Yale or CalPERS or the Norwegian Sovereign Wealth Fund seems just profoundly misguided.
I love picking on these guys too, and you guys have probably seen me do it on Twitter and elsewhere, because these big institutions in 2020 have an almost near impossible mandate. And you've seen the drama that's gone on with two of the biggest, Harvard Endowment and CalPERS, because you have so many different vested interests. For Harvard, you have current students, you have alumni, you have future students, you have teachers, you have workers at the endowment, on and on and on. And the reality is, a buddy of mine, Peter Mladina, who's based here in LA, used to work at Waterline, I think is at Northern Trust now. He wrote a paper years ago that said you can just basically deconstruct Yale into a very simple factor-based exposure, add, sprinkle on a little leverage, and voila, you end up with the Yale endowment returns. Now, you got to give Swinson credit, like you guys mentioned, that he made those decisions at the time. He made the decisions to have more of an equity exposure, whatever it may be. That private equity is essentially LBOs, or essentially small cap value. On and on. Dan wrote a paper about that as well. Mm-hmm. But Swinson gets a pass because they've done well. But going back to our original comments about underperforming, he doesn't, even Swinson, the most famous name in all of investing, he doesn't have an infinite pass. So I keep saying to all these endowments and big institutions, I said, you should just be managed by a robot. Just be done with it, CalPERS. Your returns are no better than buying the global market portfolio with low cost. You can fire everyone, be done with all these expenses, and just move on. And in many ways, the ways that you have to outperform creates even larger fractures, because if someone sees to move the needle on a 30 billion or 300 billion endowment, like you said, you got to move hard in the paint to something. Yale has less than 3% in U.S. stocks. that's pretty hard in the paint one way.
Agreed.
Now they get the beta elsewhere, right?
Yep.
Of course, but
well, yeah, the 3%
that creates
public
looking
US
different.
stocks.
And how many people are willing to look different for long enough? Again, Swinson can, but
3 years, right?
He
That's
gets,
what you
he gets a
mentioned.
pass. Yeah, 3 years. He gets a pass for a while.
And I forget which one of the endowments it was that we were recently talking about, that their great idea to overcome low expected returns in the coming decade or so was to lever up.
CalPERS.
So was it CalPERS? All right. So at the end of the day, they're just moving from a 60-40 to a 150-60 or whatever the math is. I probably bundled that one up, but they're probably just augmenting the beta to the entire market. They're just getting more exposure and creating more FOMO. So to answer your question, Adam, why doesn't the average individual out there who has nimbleness and size, like lack of size, in order to generate true alpha? Because his attention span and his ability to hold is probably 6 to 12 months, not even 3 years. 3 years is at the far end of that spectrum. And he's just looking to quench that FOMO. And so if stocks continue to rise, I mean, how do we address that? I think, Meb, you probably might have a thought or two on that.
I had a thought or two on everything. The biggest cringeworthy stat of this year for me is, the consistent investor estimates for what they expect their portfolio to do. And every survey says the same thing, and it's consistently 10% per year, 10% per year.
I saw you posted
this
15%
year
a year or something.
They broke out the equity markets by country, and the U.S. was the highest because the U.S. has been stomping everything else, and the U.S. was at 15%. There's an old, great Jason Zweig article about Charlie Munger, and Charlie's talking to one of his buddies, and he says, in his literature, he says, we attempt to get 20% returns. And Charlie asks, I'm paraphrasing, obviously, Charlie asks his buddy, he's like, he knows that's impossible, but that's what his investors want to hear. And so they're playing this game that they know 20% returns, you quickly become one of the richest people on the planet. You don't have to compound 20% for long, and you become unbelievably rich. So kudos to the people listening that are hitting 20%. The problem comes with expectations, right? Unless you study history, and this is hard. We don't teach personal finance or money or investing in any of the schools in the US. I don't know if you guys do. There's a huge gap on understanding just basic personal finance. And so just like in a relationship, with your husband, wife, kids, parents, there's reality and expectations, and you have a big gap and it doesn't happen, that creates big problems, And so with investing, all of a sudden you're expecting 15% returns. Are you kidding me? And you get a few years of negative or 50% decline or an 80% decline, chances of you staying the course is zero. It's an unwinnable problem. And this, again, I think, by the way, this is not just individuals. I think institutions are equally as atrocious at this.
100%. Second that motion.
It's because they're effectively individuals, because it's the individuals that are motivated by agency effects. Nobody is genuinely concerned about the long-term welfare of the plan. They're concerned about the sustainability of their job and their bonuses, right? And I don't mean that to paint everybody into a corner. I mean, I think this is just the natural state of things, right? We're motivated by incentives and by the own risks to ourselves and to our families. And therefore, if you're going to align incentives so that you're going to reward or penalize a CIO or an investment committee or a PM based on 1, 2, 3 year performance, then you're going to have counterproductive activity because you can't manage returns over a 1, 2, 3 year horizon. You certainly can't manage returns at that horizon at that size of a fund where you don't have the ability to take active swings at the market with any regularity. So, I mean, the system is set up for failure. And I think one of the things, if we want to keep coming back to Swinson, but if we want to give him a pat on the back, I think it's for stacking his board with people that supported his very, very long-term objectives, right? And so he wasn't marking his PMs and his managers to performance benchmarks over ludicrously short time horizons, and his board wasn't marking his own performance to short time horizons, and it allowed him to effectualize theses that were able to play out over 8, 10, 15, 20 years, right? Which I think is a major arbitrage opportunity.
He also states in his book that he looks for non-economic maximizers as portfolio managers, those managers who will stop taking money when their strategy stops working. Like he states this as I'm looking for people who are craftsmen first, and the pride in the work is that now this is insanely hard to find, obviously, but he states that as a goal, which again, I mean, so there's some questions like, in the chat too, given the shortcomings that we're talking about, what does an investor do? What are some of the solutions? And Swenson's, we're talking about Swenson, but these are some of the solutions. You do need to look for, strategies in novel areas. You do need to consider asset classes that are diverse and do the yin and yang and zig and zag. And you do need to be disciplined and patient, and you do need to have a process to understand when a strategy is in a low, no return, understanding if that strategy is A, broken, then sell, B, if not broken, rebalance, and don't sell. I mean, just the process of having 10 managers with a 0.5 Sharpe with an average vol of 10%. If you fire those managers when they're down 15%, you will fire 14 managers over 10 years. In the process of firing them during the drawdown, you are eliminating those sources of diverse return, right? So you're eliminating the bounce back. You're accepting the risk of those unique strategies that you culled and cultivated and included. You've accepted the risk and are not going to get the rebound or the return, and you've reduced the diversification in the portfolio. And that's what happens over and over and over again. Go ahead, man.
We spend a lot of time thinking about behaviorally, what's the best way to solve this, and the one thing, and this is mentioned in the comments, that private equity does right, and this is, I think, actually more of a feature than a bug, is you're locked in for 10 years. Now, there's good and there's bad to this. It's sort of a wink and a nod and a handshake between the managers and these institutions because they charge ungodly fees. And so, that's the downside. Now, the good side is that there are products and concepts that I think are beneficial. If you look at the annuity space in the United States, the problem with the annuities, again, ungodly expensive, but there's some, and they're unbelievably confusing. So you think about talking about personal finance is challenging, talking about ETFs or, the basics of spending and investing. You go through annuities and it's like 400 pages of disclosures and fees and just, it's a mess. But the concept of locking in money, avoiding taxes, low cost, I think allocation is sound. Say, hey, put your money where your mouth is. You say you're really saving for an event that's in 10, 20, 30 years, lock it up. We've explored some ideas we've talked about. I don't particularly want to launch them yet because I think we'll get sued. There was the Forever Fund idea we had, which was you invest, you're locked up for 10 years. And there's a penalty. So if you exit in year one, it's, I don't know, come up with the number 10%, all the way down to year 10, in which case it's 0. So that's the hey, I got to behave part of it. But the carrot and stick part is that money doesn't go to the fund manager. It goes to the remaining shareholders as a dividend. I think it's a really fun idea. So you get rewarded for other people being morons. I just think I was talking to Jason Zweig about it. And he's like, dude, you'll get sued.
It's like a taunting, but for bad behavior instead of death.
Yeah.
That's actually
so if any listeners,
Canadian insurance policies.
Yeah.
So I don't know if the U.S. policies have the same thing, but if you're in a Canadian insurance policy and you opt for what they call dividends, those are the lapsed profits from lapsed policies that go to the holders of the insurance that stay longer. Now, again, as you point out, try and figure out, read an insurance policy and all the disclaimers, and that's not in plain language.
We'll speak very quickly about another area. Again, this is for the Americans. I don't know if you guys have anything like it, so let me know if you do. I think one of the most impactful pieces of legislation of the past decade, could be the past few decades, in this investment world that 90+% of people don't know about, works to solve this problem. Now, the problem is it, for the most part, has only been available to accredited investors, and the accreditation rules in the U.S. are starting to move in the right direction. I still think it's been wealth-based. Now they're trying to do it a little bit of knowledge-based. My idea is like just put on online tests, DMV, let people, if they pass it, good. Let them nuke their money. They can already nuke their money in futures, options, pink sheet stocks, Forex, like, come on, private. So the concept is this qualified small business legislation that I think passed during the Obama years that basically says if you invest in a private company with less than 50 million in gross assets and you hold it, and I'm getting this broadly correct, and you hold it for 5 years, your gains are tax exempt up to $10 million or 10x your investment, whichever is greater. So think about that for a second. All of a sudden, to the extent you can put together a portfolio of private stocks and match the S&P. Now, we're not talking about investing in your buddy's pizza place down the road and, a microbrew company, or the equivalent in LA would be your buddy's movie. Like, those are probably going to be zeros. But to the extent you can at least reasonably match, that creates an interesting alignment. Now, you got to do the work. There's lots of these platforms out there, but the extent you have the lockbox, like, you can't sell those. They may go public one day. They may get merged or bought. 95% of the people don't know about it. I think it's an interesting hack. And there's other ways to do these things too, with ETFs and public market vehicles. But people spend very little time on these ideas because it's hard. It's a lot of work to understand them and explain them and put them into practice too.
Don't you think that's one of the main ideas of why small business is so successful? Right. So when you look at where the creation of wealth comes from, there's a pretty significant chunk that comes from the entrepreneurial nature of a business growing, going public, in some cases, often being taken out by a larger entity, which is, we have a business, that capital's in a lockbox. You go to work every day, things get tough, you work harder. That's a little bit different in the investing world, right? You double down, you think harder, you operate the business. You grow that, and at the end of a 30-year entrepreneurial journey, you have some sort of business. Even look at Cambria and the company that you're building, right? That is sort of that long-term deferred compounding of growth, where you can't just take it out. You can't look at the price and say, "Hey, cash me out for 10% of that," or something like that, right? So that the added tax benefit on that would be, I think, incredible. Although I do think there would be people who figure out how to game that.
Yeah. Well, we have a piece coming out that I haven't published, but it's basically ideas about policy and how to get a system that encourages the broad populace to own stocks and have an interest in the closing this wealth and income gap, and so one of the ways you do that is you make everyone an investor and that has a share in the ownership of corporate America. That way everyone's on the same side. Right now you have less than half of the people in the US own stocks. So Amazon and Apple, you see what's going on. They're hitting $1 trillion. Super wealthy people are invested in stocks. Poor people, mainly it's just their house, if they even own that outright. And so coming up with policy ideas that get people to reward this concept of entrepreneurship, capitalism, free markets, so that we can all have a stake and cheer for free markets doing well. So we can all cheer for Elon as they become $1 trillion company, but it's challenging, right?
You'll never extricate the Fed from the market if you do that, right? I mean, if it was tough before because of the wealth effect, because a section, the highest earning section of the population couldn't deal with the wealth effect when the stocks go down. If you do that for the broad population, then forget it.
There's ways to solve it, though, and we should have done an idea. If this was a drinking session, to each one of us could have put in a word that the first time it gets said, everyone had to take a sip of their drink. Mine would have been fed. So there's plenty of ideas around that I think are totally reasonable. I think concepts like copying Australia's pension fund superannuation system is a fantastic system where ours is so complicated. You opt in, you're forced into it, you save time. They love it. Everyone in Australia loves it. And they have a great retirement system. There's 3 or 4 more ideas. We could spend all this time talking about policy. But I imagine you guys would rather talk about investments. But there's ways, I think, around that. People were talking about universal basic income, and I say that's a horrible marketing angle. It's like talking about the old school death insurance. Once they moved to life insurance, everyone bought it. Universal basic income doesn't check the box in the United States of people of this concept of enterprise and thrift and building businesses. There's a very negative connotation to welfare and handouts and socialism and communism, right? Everyone just goes crazy hearing all those terms, but come up with something like, the freedom dividend, or where it's like, hey, you have a stake in the GDP of America, or whatever the country may be. You could tie it to, like, going back earlier, the long-term compounding. Every baby born gets $1,000 and it goes in some sort of retirement. You get to see it grow. I mean, there's a million different ways, I think, to solve this. But the goal, a few years ago, I was very negative, many years ago, on, you see these sort of sentiment indicators. Oh my God, Ashton Kutcher is investing in startups now, or Giselle's talking about getting paid in euros, like sentiment top turn. My opinion's changed a little bit. You see this culture of trickle down entrepreneurship and startup investing that I think is one of the potential booms of our next, generation, where Silicon Valley, in my opinion, used to be a place. And all of a sudden, this concept of building businesses through the accelerators, through people selling these businesses for $100 million, $1 billion, and then all of a sudden become investors in a million other companies. It's spreading to other countries. You're seeing it pretty quickly in Africa take root pretty strongly over the past few weeks, and some of these big fintech deals. I'm super bullish on that. My point being, at its core, you want people to all feel part of the system because right now a lot of people just don't. They don't feel like they're part of the investing benefits.
Aside from the good marketing angle to overcome the behavior hurdles and all that fun stuff, I wanted to go back to your original question and to see what your answers are for what the vast majority of people aren't looking, but you feel are good opportunities for the coming years.
Okay. Let me give you a few brain teasers that will, that I think no one agrees with. If you were to ask people, you poll, and by the way, I had to pay someone on Upwork to search for this because I couldn't figure out how to find all my old polls. And Upwork, if you guys haven't used it, it's the most amazing thing. I hired a guy in Poland to scan all the recipes on the internet to come up with a rankable recipe sorter. So if you guys want to know what the world's top recipes are, I can pass them along. Anyway, check out Upwork. Unrelated. So I had him look at some of these polls, and one of the polls is, what do you do with your safe money? Everyone puts it in cash, T-bills, right? Like that's the safest place. But in reality, if you look at the statistics, it's not. And so on a nominal basis, T-bills really never lose money. But over a long time period, we say, what's the biggest drawdown after inflation? And everyone said 0, 5%, less than 10%. And the answer is close to half. The 10-year bond had a real drawdown after inflation of, I think, closer to 60%. So, but what do most people do with their safe money? They put it in cash at the bank. Well, cash in the bank, I'm a like super high tier Bank of America rewards, and I get 0.04%. So essentially zero. And that's a cost each year. And we kind of went through a post and showed, if you were just willing to go through the exercise of, suspending disbelief for a minute, that you could do it even a 60-40, but better is like a global market portfolio. So call it half stocks, half bonds, half US, half ex-US over time. And you look at all the metrics. So you look at maximum real drawdown, you look at volatility, you look at worst 12-month period, you look at percent of positive months, and you find that you can come up and add, let's call it about 3 percentage points over cash with hardly any more volatility, a lower maximum drawdown, similar amount of positive months, and similar worst 12 months. And so you then make the stretch. You should be investing all of your safe money cash if you want to make that extension. Now, no one will do this other than me. I know of one other person that does this, by the way, and he's insane. So, but this is a departure. As you think about things that are safe or not safe, thinking in terms of nominal versus real inflation. So going back to the endowments understand this. The two big risks for most people, and I may have heard you guys say this, so I'll give you credit if it was, like two big risks to a portfolio: inflation over time, eroding that portfolio, or a depression style problem where the portfolio loses 80%. Is that you guys? I'll give you credit if it was. So that's an idea. And in that world right now, obviously I love stock valuations. We believe that, foreign markets, in particular emerging markets, and some of the cheapest countries, I've been saying this for years, so it hasn't happened yet, but although it seems to be turning last few months, since April maybe, I think they can still do double-digit returns over the next decade. I think the U.S. is going to be facing significant headwinds, though.
What was interesting, because the funny belief there is, I think I've told this story before. I was at a meeting of portfolio managers with Schiller, and someone was talking about the valuations of markets and how are we going to get returns, and he simply said, "What do you mean? Like, the valuations of markets are wonderful. Czech Republic, Russia." He went through the list of all the single digit multiple countries, and the whole room sort of giggled out loud, and he was being dead serious. He's like, there are fantastic valuations and long-term opportunities. The markets aren't over. What market? Which market are you referring to? And it is. We come back to those behavioral bias. I'm not familiar with it. It hasn't done well. So I've got my recency bias. I've got my overconfidence bias in the current paradigm.
Home country.
What chance does a guy have?
You mean you don't want to own any of those things? Why do you think that they're likely to earn a good return?
Yeah. Tobacco stocks in 1999 as CalPERS, swore off tobacco. ESG, oil and gas stocks today. I mean, there's some parallels around.
I do think that just like returning to sort of the higher order question, right? Like, why is it so hard for investors to stick to investments or a plan or what have you? And I think the great conceit that we all know, because we've lived it through many interactions with investors over the years, the great conceit is that investors are in some way mean variance optimizers, right? That they actually care about efficient portfolios. And I think the reality is, and Eric Falkenstein's got just an absolutely brilliant paper on this, but I think all the research suggests that, in fact, the objective function is status seeking, relative status seeking. So, like, if investors really just want to avoid being poorer than their neighbors, and they're not actually concerned with maximizing their own personal wealth and minimizing the chance of loss, then all of the different optimization methods and portfolio construction methods and asset allocation approaches and all that other stuff that we all support and advocate go out the window, right? What ends up being the most efficient portfolio is, in fact, for many investors, 100% in U.S. stocks, because that allows them to have the least likelihood of falling behind their neighbors who are also invested mostly in U.S. stocks. And so I think we've got to be humble about what we are targeting for investors. I think, like, certainly at Resolve, we always focus on what's optimal from a mean variance perspective, and sort of scratch our heads about why people never actually behave in a way that's consistent with those objectives. But from a practical standpoint, all the literature suggests that nobody gives a shit, that everyone just cares about what their neighbors are doing and they just don't want to fall behind.
So it's a great point. Like, that probably is the number one question. What's the objective function for the investor?
And there's so much preference falsification. Everyone says it. They don't care, or they want to maximize wealth, or they just want to pay for retirement. But that's bullshit, right? It's just
they say that because their friends say that.
Well, sure, and they think that that's what they should be saying, and that's what you want to hear as a professional, right? But that's not actually at all what they want, and so you need to sort of read between the lines and invest between the lines, so to speak, rather than trying to take things at face value sometimes.
Preference falsification would have been my second phrase for drinking today on the
honestly,
podcast.
I would have chosen MMT. Because as soon as that genie comes open, that's got to be said a million times.
That's true. So,
but I thought you might go down some Bitcoin or cannabis or some other different path on your out of the box ideas, I guess, because cannabis is so out of favor. Although if you're reading into the FinTwit space, Bitcoin is definitely not a contrarian idea by any stretch of the imagination.
There's a couple things wrapped in this. As Mike mentioned, every asset class at some point is dear, and at other times, wonderful, terrible, everything. It doesn't matter what it is. Schiller actually wrote a paper looking at sectors as well, going back to the early part of the 20th century. And there was a period that like boring old utilities traded at a CAPE ratio, in the roaring 20s of like 60 or something. And then fast forward 3 years, they were at 5. So you can have a bubble in the most boring stuff in the world. And, look, the whole point of free markets and capitalism and the way this works, you go back, we were sitting around here, 1899, sipping tea or champagne. I mean, you invest in the UK was the biggest stock market. US was second. And I don't think anyone would have predicted the US going from 5% of world market cap to 55 today. Mm-hmm. You certainly probably would have bet on Germany and France and Switzerland and all these other countries, Argentina. But it was like 75% rail stocks. Like that's what your market cap portfolio is. Rails now are like less than 1%. They've done great. They beat the overall market over that period. Tobacco stocks, single best returning industry of all time. That's near and dear to my heart as a partial Winston-Salem, North Carolina resident, where my high school is named after. I literally went to R.J. Reynolds High School, so literally named after essentially a tobacco company. But the lessons you learn is that constant is a change, and so the beauty of buying the entire market cap index of the world, and there's been a lot of great literature the last 10 years on this that I think is opened a lot of people's eyes. Everyone in private equity and VC understands power laws. You invest in 50 or 100 companies, it's the 1 or 2 Ubers that generate all of the return. And that's hard to get your head around. It's also true in public markets. And so it's like 5 or 10% of the returns of the entire market is dominated by these stocks. So you kind of have to own them. That's why market cap weighted indexing works historically. You're guaranteed to own the winners. It's like 2/3 of stocks underperform the index. Almost half have 0% rate of return, and like a quarter goes straight up to 0. I don't think it's optimal or ideal because it overweights bubbles and underweights busts. So the examples you give, when energy was at 30% of the S&P, you had 30% of your money in energy. Well, now that's 2%. Japan.
That's what gives you the upside, though, right? It's the market cap weighting that buys more and more and more of it all the way up.
It's the most beautiful trend following index of all time. But on the flip side, you have things like Japan, where the biggest bubble we've ever seen hit a P ratio CAPE of almost 100 in the 80s, and now, really, essentially, last few years, breaking out to levels 30 years later. Again, this is a top 3 world economy, once the world's biggest stock market. So the problem with the market cap, the good part, you can go to a cocktail party, say, I own Tesla, I own Amazon. You're guaranteed to own the winners. The problem is there's no fundamental tether to valuation, earnings, sales. So kind of combining the two, coming up with any investing approach that will give you the upside of owning the big 10, 100, 1,000 baggers, which you have to. By the way, if you own them individually, 0 chance you keep those till they hit 100 bagger status. We did another poll where we said, people, what's the best investment you've ever had? And everyone, for the most part, was up to 10x sort of returns. Because damn it, you invest in something. I mean, look at Bitcoin right now. It doubles. Oh my God, everyone, like the world is going to go insane. There's stocks all the time that go 10, 100x. It usually takes a decade. And the problem is these massive compounders is people want to sell them all the way up. But anyway, indexing guarantees you to own them.
They also have massive corrections, right? Amazon had, I think it's more than 3 75% plus corrections on the way to where it sits today. So how many of those are you going to sit through, right? To get to where it is there, right? Some people did, but they were, Jeff Bezos, right? So him and a few other insiders, but as an outside investor, it got a little out of hand in 2000. And how did you know that you didn't own like Yahoo? Like how did you know it was Amazon at that time.
This is why we need to come up with an ETF lockbox concept. The generational wealth areas, real estate, farmland, private equity, like people get it. And, they understand this concept, but with public markets, it's impossible. It's so hard to own things when they go up.
So true.
Meb, shifting gears slightly, and maybe this is one of the words that is going to spring a drinking behavior here. But do you give any thought about the possibility that we're going through some form of a phase shift in markets, or sort of a paradigm shift, to use a term that's been beaten to death, and how, from a systematic perspective, do you think about that through your models, and how you might approach a new normal, a new reality of maybe central bank forces plus some of these liquidity aspects, going by Corey's liquidity cascades paper, just some of these different forces that appear to be changing market behavior? How do you think about that?
I have a tweet thread that I was reviewing prior to this about a year ago that listed a bunch of my beliefs that are not consensus, meaning, 80% of people, pros, don't believe it. And one that I think everyone hates, as I'm like, Fed's done just fine. I mean, everyone goes crazy about that. But my opinion is, look, markets, Fed's been around for over 100 years. Central banks have been mucking around with things. I mean, we've only had a floating currency system for 50 years? Like, people love to act like we've had a gazillion years of financial markets to draw conclusions from. And I mean, it's not that much time. It sounds like a lot of time. It's not that much time. We love to talk about, prior to this year, we had a tweet that said something along the lines of, it's interesting, decade ends often mark inflection points. I said in the 80s was the biggest equity bubble we've ever seen. The 90s was this internet year 2000. The 2000s was the global financial crisis. Wonder what the 2000s or the 2020s are going to bring, and sure enough, 1 month in, we have a pandemic. So that wasn't forecasting anything. It's just the constant of markets being, new every day. And so we always talk about a client letter. Every time things go wrong as advisors, we love to reach out to clients, say, no, we've modeled this. We've seen this before. It's okay. And I joke that the way it should be written is it's okay, clients, we've never seen this before, because every day, every month is going to be something new. This year, fastest ever from all-time high to bear market, and boom, right back. So you're going to constantly see things that no one's ever seen before. Maybe Bitcoin goes to $1 million and we move away from a fiat system. It's possible. So you try to come up with the probabilities. I think the biggest problem for most investors is they adhere to a future that they label as certain, that whatever their approach may be, and they don't consider the possibilities. 1917, Russia says, thank you very much, markets close. 1949, China says, thank you very much, markets close. And on and on and on. You can have government saying, nope, short selling is illegal, yada, 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 taking over companies, but also on the optimistic side, of things that get invented, new approaches. So I think the theme of regime change is always constant. I think you will be dealing with weird shit going forward every single day. That's what makes our job interesting, and coming up with possibilities to manage assets that's, pick your phrase, anti-fragile, robust, that can just survive. That's the big part, right? Not to get carried out. All the gamblers know this. We said on Twitter the other day, most investors would be better suited to be less Nostradamus and more Rip Van Winkle. Come up with an approach that considers the possible outcomes. And that's what most people don't. They say, I expect 15% stock returns. That's going to happen. Boom, something else happens. Look at bonds. Bonds is the weirdest, sort of, if you were to rewind 10 years and ask me, what does the future look like? And you're like, all the sovereigns in the world are negative. I'd say that's pretty weird. You can get a mortgage in some countries negative. I wouldn't have predicted that. So anyway, it's, my belief is there's always going to be regime change, and you just have to be willing and hopefully set up to survive it.
Dear
On
client,
that note, actually, I'm curious.
something went wrong.
Mhm.
That's why you're getting this letter.
Yeah,
And we had no idea that this thing was going to go wrong.
Something else will eventually go wrong, and we won't know about that either.
But some things will go right, and we won't know about those either.
Exactly. I remember going back to your paper, whatever, 2008 or 2006 or whatever, and with your 10-month moving average, et cetera. And correct me if I'm wrong, but didn't you have a commodities sleeve in that original paper? I may be wrong on that, but either way, I'm just wondering, like, what are your thoughts on commodities, right? Because you talked about how a global stock bond portfolio, 50-50, international, US, whatever, was relatively resilient and had very manageable drawdowns, et cetera. I think the worst period was the 1970s, right? So I'm just wondering, like, what do you see as the role of commodities, or like, what's your view on that in a portfolio?
I'm just at this point trying to poke Adam with alternative views that are going to cause him to have a conniption by the end of the day. Starting with the Fed,
I left that one
paper.
Alone, notice.
By the way, my opinion on the Fed, by the way, is it also should just be automated. I think their policy target should be also a robot, but that's neither here nor there. Thinking about, by the way, one more comment, and then we'll jump onto the paper. Thinking about a comment on going back to the very beginning of our discussion, talking about what's possible and outcomes. Barron's had a recent poll where they said, where do you expect interest rates to be? They didn't even have negative as a choice. So what would really just drive people insane is U.S. Treasuries go negative at some point. Possible, probable, who knows? But just that's a funny data point we can come back to. So that old paper, look, this concept of trend following, we already talked about market cap weighted indexes being the ultimate trend following exposure, then applying it to entire asset classes. We picked 5 out of a hat back then. Again, I was in my 20s at this point, was trying to avoid taking a test, writing this paper, didn't want to write a paper, never written a paper before, had to get it in by the deadline, December 31st. I was like, what can I write about? Let's pick 5 asset classes, 5 just big ones. And it was U.S. stocks, ex-U.S. stocks, bonds, REITs, commodities. The asset class really doesn't matter, by the way. And then we'll get to your concept about commodities. We did a retrospective 10 years later on this paper, and it's been interesting, depending, as you guys talk a lot about with ensembles, about composites, any one indicator, certainly something like if you apply the 10-month or the daily equivalent 200-day moving average, you apply it to one asset class like U.S. stocks, 1987, 200-day and quicker, you were out. You missed it. Hallelujah, career maker. 200-day or longer, you sat through the crash. Not as bad as I remember hearing Jim O'Shaughnessy talk about. He had a huge put position on the S&P and sold it the day before the crash. It's one of my favorite stories. But trend following in general, on average, and I think 2020 is a great example. It does its job over these long bear markets. We wrote a tangential paper. One of my superhuman abilities is mispronouncing words, by the way. This year that no one read because we published it sort of near the pandemic peak apocalypse, was investing at all-time highs. And it's such a fun paper because most people, when you think about, because markets were hitting all-time highs in January and it was like, oh my God, this is crazy. But the reality was that you invest at all-time highs and you give it a buffer like 5% or something. Does the monthly close within 5% of all-time highs? Otherwise you sit in cash. Every single asset class crushes buy and hold. 12-month, you do a 12-month look back, also crushes buy and hold. And the whole concept of trend following and channel breakouts been around since the time of Charles Dow 100 years ago, Donkian 70 years ago. It's just you're just not sitting and holding things that go down 90%. So you stay in the game. And that's sort of the takeaway from the paper. Commodities, are a little different because, as you know, as a farmer that I am, as I know, you can't necessarily replicate spot in the world. So then you have the financialization of all these contracts with futures. Then you're introducing things like contango and backwardation. we've had kind of both sides of that discussion on the podcast of people, that are like, this is the worst idea in history to invest in commodities through futures contracts, and other people that wrote the original papers and said, it's actually a great portfolio diversifier. My opinion on commodities specifically is they're probably more amenable to trading than long-term holding, although I think they're fine for long-term holding. I don't think you're getting equity returns. And if you disconstruct the holdings, and we'll bore everyone to death with this, of course, a big portion of that historically has been the collateral yield. But I think that's true with everything. And I don't know that other people believe this, but I think a big portion of stocks, of bonds, of everything. Yep. In a world of 10% bond returns, bonds, and it's not actually the bonds, it's the inflation usually. So they're tied at the hip. Anyway, so things like gold, again, I think the takeaway and why I model my own personal portfolio after a 2,000-year-old investment strategy based on the Talmud is about Talmud. See, I can't pronounce anything.
Oh, I don't know. I said the same
I don't know either. My wife's Jewish. I got to ask her. It's basically like every man invests a third in business, a third in I forget what they call it, real
land,
it's like housing,
land,
and a third in keep and reserve.
Yeah,
and I try to model my own personal after that because businesses, stocks, private equity startups, cash reserve sort of concepts, and then real assets. And most people, real assets is their house, but also commercial real estate. The two biggest, by the way, of the global market portfolio, the two biggest areas that are not well represented, I think, are farmland and single family housing. Most people already have the single family housing. It's not diversified. They just own their house, but getting exposure to those two. So however you approach the real assets, could be through tips, it could be through a combination of all these things. The commodity futures was such a fantastic example of the institution. Every 3 years, you go to these conferences, they get obsessed with something. 2005, 2007, oh my God, were they falling over each other for commodity exposure? And for the most part, CalPERS and a lot of these others have now puked it up. They're like, that was so stupid, sell. So it's probably a great time to be buying them. It's just a little more problematic, the execution of it, right? You guys all, I'm sure, are sitting on a pile of gold bars, being Canadian, under your chairs. So it's a little different. But I think the concept of real assets is sound. The execution is a little harder.
Yep, fair point. On the commodity side too, it's sometimes the construction matters, right? One of the surprises, we just wrote this paper on rebalancing premium, but one of the surprises is just how diverse the commodity universe is. And if you can take advantage of that diversity a little more thoughtfully, then you can, even if the actual commodities on average have a 0 compound rate of return, you may be able to generate 2.5% compound growth just from the rebalancing premium on 7 or 8 different independent sort of commodity bets over time. So that was an interesting realization, and another sort of reason to maybe consider a strategic allocation to the right kind of commodity portfolio. And as you say, right, commodities hedge a certain type of risk, but then housing and tips and other different asset classes can also play an important role in different types of inflationary environments. So you've got to be humble about the bets you're taking.
Well said, Adam. What else can we argue about? We need something.
Yeah, I've resisted. You've laid a couple of easy ones out there for me, but it's the day before Thanksgiving, and we're such a friendly bunch on the Resolve Riffs broadcast. We don't like to get in arguments.
I thought Meb was going to pick up on the Bitcoin thread that I dropped a few minutes ago, but I got nothing from him. Maybe
I'm the only person. I will explain my approach to Bitcoin. I also think I'm the only person on the planet that believes this, that has these 4 criteria. One, I've been a long-term proponent. People have seen me talk about it for forever. We used to have pay with Bitcoin on our Idea Farm service like 7 years ago. As a somewhat broadly libertarian, free markets kind of guy, I like the concept. There's nothing I love more than poking fun of my crypto friends, because on average, they're absolutely insufferable. you know, so it's just like I can't even with him. That having been said, and you guys know, I write a yearly article. I talk about how I invest, you know, and for the first time ever bought a handful of crypto this year. But lastly, so I find people insufferable that own it. I own it, but I find it incredibly, and this is, people are going to, you know, dunk on me for this endlessly. You don't understand it, whatever. I find it absolutely and totally disinteresting. I think it's one of the least interesting things on the planet to me. It's like a distributed, you know, I get it. And I did a tweet a few years ago and I said something along the lines of, you can come up with bubbles in anything. It was like, you know, Pokemon cards, Cabbage Patch Kids, online databases and distributed ledgers, like just worked it in there. But I also, like, you know, going back to this concept of from an investment standpoint, you know, again, my article, all-time highs, not bearish. If it's hitting all-time highs, like, God bless you, own it. Good for you. The thing is, like, if you were to ask me, Meb, would you rather have a portfolio of 100 amazing startups that are trading at, say, $10 million valuation, that found product market fit, have $1 million in revenue, are changing the world and doing cool shit? There's companies like, you know, building the next commercial space station, companies trying to solve loneliness by connecting seniors with young university age students to help them get, like, on and on and on. And by the way, those have the potential to go 100x, 1000x. Like, in every possible scenario, I want the basket of startups. That having been said, the advice that I give to people, because I'm allowed to give advice, it's not my show today, over the years, people would just ask me, you know, maybe it was 2 years ago, they're starting to ask again. They haven't asked, and they asked 2 years when Bitcoin was at 3,000. They asked when it was at 20, and they're asking again now. I say, look, you want to buy some, own it as a portion of the global market portfolio, which I think around now, all the crypto combined is about 0.1%. So I go, you want to go wild and crazy, buy 1%, and guess what? It 10x's, it's now 10% of your portfolio. At 100, like, it'll get bigger. Good for you. It goes to zero, same. But this applies to everything. Like, the person that wants to put all their money into Apple, I tell them the same thing. I'm like, dude, that's, you know, buy a little bit. But so anyway, that was my short summary.
Actually,
I managed to offend everyone in that.
Satiate your
think,
tracking error, because it's a status seeking. Like, all the hodlers are going to be out there. They're going to have it all, and that's their group.
Not to mention, he slipped in right in there a reference to Sugar Daddy company startup, which
I heard that.
Oh no, it's called Papa. It's called Papa. It's like an Uber for loneliness. It's not that one. It's it's one of my favorite ideas. It's like,
it's not Poppy, it's Papa.
Like, they'll take you to go get your groceries. They're having explosive growth. They're crushing it. You want to go hang out and play chess. Like, one of the biggest problems of the pandemic is that is revealed is a big problem with mental health and loneliness, you know. And I think you know, not just with drugs and alcohol, but applied to so many different ways. And I've invested in a ton of startups that are trying to attack that from all sorts of different angles. I love this one as one. Hey, if it ends up being highly attractive, 20-year-old co-ed boys and girls, God bless them. But it's merely meant to take care of your groceries and hang out. Yeah. I had something to say, and you totally derailed it. What was I talking about?
On the crypto side?
I know what it was. There's two parts of the crypto story that I find that I love to tease people. One is we have the HODL ticker. So anytime anybody wants to launch an ETF in the crypto space, they talk to me. But God, what was the other thing? Oh, my favorite tweet of all time. And I was poking the crypto community. I was hanging out with Jeremy Schwartz of Wisdom Tree in Switzerland. That sounds so insufferable to say, but I was randomly giving a talk in Switzerland. He was in Switzerland, posted on Twitter. He's like, I'm here. So, like, we went and met somewhere and had a cocktail. It was freezing cold outside. Made fun of him because the cocktail he ordered was like pink and came with a spoon. But I was teasing him, and I said, I posted a photo of us, and I said, Jeremy's here talking about how they're getting ready to launch a Litecoin ETF. And this was at like peak cryptomania. And oh my God, the internet just went insane. They were so excited. And then once,
Oh my gosh.
like the next morning, Jeremy wakes up. He's like, dude, you have to tell people that wasn't true. I'm like, I don't know. It's not true. You guys might launch one. I mean, like, and it's Jeremy's like
Tesla
trying to
420.
yeah, he's
Financing
trying
secure.
to do damage control. Be like, no, he's kidding. And the amount of hate and DMs I got from that one tweet was significant. But Wisdom Tree, if you're listening, I don't know that you're not going to launch a Litecoin ETF. So TBD. VanEck just launched one in Europe today. So good for them. Who knows?
I know they're bringing out an Ethereum one in Canada too. They're launching another. They got the Bitcoin closed-end trust.
They raised a
got an
bunch of
Ethereum
money
one.
in the Bitcoin ETF here in Canada.
60 million.
Trades at a big premium as usual. And
My favorite way to tease the crypto, I've listed like 9 already, is to say, back when people took airplane flights, is I would say, I'm about to go mine a bunch of cryptocurrency, old school, best cryptocurrency in the world, United Air Miles. What was it called? Mileage Plus. And I'm like, the good news about this is I can actually use it for something. Like it's an actual currency I can fly around the world with. Bitcoin, it's like impossible to do anything and transact with it. But frequent flyer miles, favorite crypto prediction for the next 10 years.
yep, they're all going to go on the distributed ledger, as you say.
Yeah.
Exactly.
Oh, that's awesome.
Is that it?
I don't know. Any other hot
I booked
topics?
4 hours. What else are we talking about?
Let's do
I
it.
had something else I was going to ask you, but I was going to let you off the hook being pre-Thanksgiving. But I was wondering whether, 'cause as a podcast host, I find you have all these conversations and you're always asking questions. And I always wonder, like, is there, you spend so much of your time as a podcast host and obviously much less time by definition on the other side. And I'm just wondering, is there anything that you wish that you were asked more frequently, or that you never get asked, or that you're dying to talk about that you never get a chance because you're always on the other side?
I think a good question that to talk to people about, no matter what, is in a universal one, is just kind of like, what are you excited about? What are you working on these days? And you can see people light up about, whatever it is they're into. It could be rugby. It could be, coming up with some new recipe startup, like who knows what it is. That's always a fun question to me because it gets people talking about something they may not have even revealed publicly. Anything you guys got up behind your brain that you're working on? Adam usually puts out like a 400-page something other every once in a while with the most beautiful graphics. You guys put out one this year, didn't you?
2, I think. Yeah, we put out maybe 3. Actually, I think we did a portfolio optimization on stocks, and then we did a risk parity paper and how to evaluate risk parity strategies, and then an appendix on the rebalancing premium of risk parity strategies. But you said you're working on a paper, right? I'm actually super curious to learn more about that. If you're actually interested in talking about it on policy, like what are there 3 or 4 key themes that you're going to hammer on? Or?
Yeah. So, and by the way, when you guys want the domains risk party and risk parity, I have both. You guys can have them. Risk parity I sold. Somebody in Switzerland owns it now.
I like risk party better.
Yeah, I do too. Like when it's crushing it, just be like, let's go. Risk party is on. My favorite thing, and you guys as a fund manager are in this boat, is ideas that are actionable. So something you can actually like put to work. I mean, the vast majority of Twitter, not just in the investment world, politics, is like people are amazing at the diagnosis. Here's the problem: rant all day, rant. And politicians are incredible at short-term fixes. What they're not great at is, I think, the prescription. I got into a big fight a few years ago publicly. Was speaking at a university with one of the mutual fund cults, and on and on and on about passive and active. Oh my God, just like he had some of the right diagnosis correct, but the prescription, had you followed his advice, was that you should fire him and hire someone else because he charged some just insane fee just to do buy and hold. So you always got to be careful between like, here's the problem, and then extend it to what's the actual solution. you know, and a lot of things, it doesn't have to be world changing. It could be something pretty simple. Let me see if I can even find my post. You know, the big white whale for me, of course, is the education, the fact that we don't teach personal finance. It's like 12% of schools in the US is so embarrassing that it's just like, I can't even begin. And the way to frame it would be something like, you know, money and freedom, personal finance, barf, like and people always come back at me and say, no, it fails. You teach personal finance to prove that it doesn't work. And I say, well, there's two problems with that. You're either teaching the wrong curriculum or the teachers are bad or whatever. And one of the benefits of 2020 will be that as education moves online, instead of a 10 million teachers where some are not great, hopefully some of the best teachers and curriculums bubble up to where everyone can participate. Yeah. So in many of these cases, I post both like public policy solution, but also, hey, private market. I think there's a massive opportunity for what we call, like, and we wrote about this like 5 years ago, Rosetta Stone for investing. You want to teach someone a coursework on how to do the basics of personal finance and investing. I mean, look, Dave Ramsey does like $100 or $200 million of revenue per year, you know, teaching it, and it's his brand, and there's things he does wonderful, and there's things he, you know, I disagree with. But the possibility is there, I think, for things like that. That's one to me that is really.
Isn't this just an extension of Khan Academy? Like, why isn't
yeah, but like look at Masterclass. They teach all these courses about cooking and creative and chess. You know, how many there are in personal finance investing? 0. You know, and on and on and on. So it's an opportunity. I don't want to do it. Too much work. You guys can do it for Canada. US, I don't want to do it. Too much work. But someone will solve it, and they'll make billions of dollars. So that's one. Teach money in school, and the concept, by the way, like, it's becoming more and more clear, I think, too, where so many famous artists, celebrities, athletes are all becoming rich. 0 of them from their career, you know, and you can just go down the list. Kanye, Jay-Z, Federer, George Clooney, Ashton Kutcher, on and on and on. And someone should write a book. I think you could even co-opt the Jay-Z phrase, I'm a businessman, and profile a lot of these famous, because that resonates with people. Like, if you're, so many people see the possibility is totally, of wealth building is insurmountable. So that's one. I mentioned earlier this concept of the freedom dividend. Again, there's like 1,000 permutations on that. You know, there's another one that I think is interesting. What's the lottery situation in Canada like? You guys got a standard lottery?
Oh, we love the lottery. Oh, we spend a lot of money. It's government owned. It makes a lot of money.
Is it scratchers? Is it like Powerball sort of thing?
All of it.
Okay.
And it's also not taxable. So when you win, you don't pay tax.
Oh, that's pretty dope. Well, I mean, look, let's be honest. What's the problem with the lottery? It's a tax on being stupid, you know, to be fair, but it's also a tax that's pretty
predatory. Regressive tax.
It's predatory on low-income people because often, you know, if you have no money and you can't pay the bills, like, to have the fantasy, like, it's insurmountable. You can never get out from under this. And like, the average person in the US spends like $500 a year on lottery. And then the active players it's like $2,000. So if you were to ask politicians, say, hey, look, this is clearly predatory. There's some better systems. The reason none of them give it up is the revenue. You mentioned, like, they're addicted. There's 0 chance they'll give up that. There's some other systems elsewhere in the world, UK, South Africa, that have these concepts of savings-based lotteries, to where you play the lottery, or you put in a deposit. So I invested in one called Yada Savings. You invest, and they do a weekly prize drawing, and you win anywhere from 10 cents to up to $10 million. And they're not paying you out savings percent, which you're not getting anyway, but they use that spread to fund this lottery. So it's a pretty cool idea that instead of you buy a lottery ticket, you immediately lose 50 cents or some, I think the expected value, like 50 cents, right? This has actually been hugely popular for decades in the UK. They've done this, prize link savings. I think someone could do it where they link it to prize link investing. So, hey, you're in a lottery, you get a ball each night, whatever, but the remainder balance, it goes into your investing account. And hopefully it's something you couldn't touch. Again, these are fintech ideas I don't want to do. I would love to see someone do it, but we have to be honest, and the problem with a lot of these savings apps that are hugely popular in the US, amazing businesses, fantastic for VCs, absolutely, I think, atrocious for actual savers. The average account balance on a lot of these is like $100, and they charge $1 a month, $2 a month, $3 a month. So what are you paying for your savings account? Well, you're paying 10, 20% a year. Like, that's insane. And I get totally ratioed on Twitter if I talk about this. People lose, like, it's the exact opposite of what people think. But I think there's a lot of ideas. They all tackle different parts, right, of this sort of problem that we're coming at. But the big one is we got to get people at least a little bit educated, I think. And then lastly is to have systems that nudge you in the right direction.
Incentives, yeah.
So I'll take, not surprisingly, maybe the other side of it. Like, it seems like we educate kids all the way up through school on how to eat healthily, and they go to phys ed class and they learn how to take care of at least the basics of physical exercise, and get outside and go hiking or go walking or whatever. And we've got an obesity epidemic and a healthcare epidemic in most Western countries. Hey, man.
Hey, guys.
So, I mean, why would we think? I mean, I personally think that one of the greatest policy errors of the last 50 years was the privatization of retirement savings. One of the great things about Australia's superannuation program is that there are very few choices. That Australians they have a program that the government sets up, and the default is we're gonna dock your pay, and it's gonna go into one of these programs, et cetera. And I mean, it just seems like you sort of advocate for libertarianism and free markets. I won't even go there with how inconsistent that is with the Fed, your views of the Fed policy. But like, I just don't think that most people, even educated, will have the discipline or mindset or in general to make those active decisions without basically most of them just being defaults.
Okay, let me give you a quick response to that. Hello, Rod.
Hey,
by the way, I'm going to compliment you guys on your choice of microphones. I'm not going to say that they have a particular aesthetic, but they do. All right. I don't know where you grew up. I grew up eating Fruit Loops for breakfast. I grew up with the food pyramid in the United States, which said you should base your diet on 17 different carbs per day. And then at the very top is like, you should, whatever you do, don't eat red meat. And we've learned over the course of history, that's probably not correct. I actually did a tweet the other day. It was like, which was the biggest lie of my childhood as a child of the 80s. And it was like the war on drugs, essentially like sugar is great and fat is bad. What was the third one? I can't remember.
Claus? Santa Claus, Easter Bunny, make it?
No, I said lie. What are you talking about? Those things are totally true.
Says the guy with the 3-year-old. Fair enough.
Yeah, and so, but we actually wrote a paper on this about essentially the investing pyramid, and I said, it's funny, and the beauty of education and knowledge is it compounds, and particularly with the internet, is it gets revealed. And so, 50 years ago, how would our parents' generation have invested? First of all, they wouldn't have. Most people didn't. But had they had a broker at Dean Witter or E.F. Hutton, they would have bought a handful of stocks, paid some ungodly commission account. They probably would have bought some CDs or some sort of bonds. But it was different. The average mutual fund was like north of 2. And so I think things get better over time. And so I think having the dual balance of a basic education, and we haven't even gotten into student debt. 17-year-old, I don't know if you guys remember being 17, but last thing I was capable of deciding was whether or not I should be taking on $200,000 and future liabilities with no framework. I could talk to you about calculus all day long because that's what we were taught. But anyway, I think there should be a basics, and then align that with systems that the incentives and the knowledge is set up in kind of the best interest, and the opting in of the I agree. I think it shouldn't be private. My God, I don't know how you guys have it, but retirement in the US is the most complicated. There's IRAs, there's SEP IRAs, there's 401k, like it's unbelievable. Like who could possibly figure that out? I'm a professional. I can't figure it out. Anyway, so we kind of agree and disagree. But
I think healthcare too. The one thing that, as a Canadian, that I getting into dealing with the American RIA network, and just the amount of gray matter that has to be put to the idea of healthcare is absolutely mind-numbing. And so the pandemic to me is also, created, there are some things that the government should be highly involved in. They don't optimize well when the free market's involved. Pandemic, management of behavior, management of health resources, management of the society based on that. These are some topics that, so that's where Adam changed my mind on, the idea of pensions, the shared risk, the simplification, superannuation. These things, there should be a good base. If you think about a Maslow's hierarchy of needs with respect to your sort of financial obligations, and then what a society should obligate you to provide for yourself, you get a long way in a behavioral management, right? The superannuation, it's simple. You got 3 or 4 choices, and you don't have one of the choices that you don't have is not to participate. Mm-hmm. And so the other theme that I'm picking up from the things that you're really excited about, Meb, is this idea of creating a community. I think that's something that is right through this. Everything you've talked about is, okay, creating communication, whether it's happiness, creating that opportunity for groups to come together and share their experiences in these sort of common themes. Is that on purpose? Is that just something that you've come to from a value set, or is that something you've sort of thought about explicitly as you're kind of wandering through the world on the Meb journey?
Well, I think the odd takeaway is vast majority of people should spend 0 time on their investing. Set up a plan. We talk about this. We say what percentage of people have a written investing plan. It's usually around 5%. And it doesn't have to be complicated. It could be 3 bullet points. It could be 20-page policy portfolio. But do you even actually have a plan? So when it hits the fan and things like 2020 happen, you don't have a fracture. I mean, I'm sure you guys know just as many people as I do that sold this year and will probably never buy again, or sold in 2009 to never buy again, or just on, because they don't have a plan. And so but once this stuff is set up, like, I don't think people should be spending that much time mucking around with their investments. And we love to debate all day, and if it's a hobby, that's fine. I'm like, look, if you're a hobbyist, you like investing because it's interesting, God bless you. Like, there's cooler things in the world, but we're odd ducks in that sense, and we do this for a living. But at least having the tools to be equipped. I was smiling as you were talking about kind of platforms and communities, because I was thinking back to the days of like Raging Bull, Yahoo message boards, Twitter now. So you get the little benefits, but also the cesspool too. Mm-hmm. But yeah, the biggest problem and the big muscle movements, what really matters, save and invest in the first place. We do the Venn diagrams. I bet most of us would probably agree with most of the big things that really matter over time. But yeah, I don't know the ideal solution for the delivery or the curriculum, but I think most of us could write it down on a napkin, and come up with something that would work.
Is it fundamentally at odds? Sorry, go ahead, Rod.
No, Rod, you're not allowed to speak this time. You just got to stand there.
I just had to come in. I had to come in and talk about that insurance, not insurance policy, but the lottery ticket idea. It really, lottery ticket idea, superannuation is all about using the behavioral tricks that we can get for people to do the right thing, right? And my father, one of the things that I think in the U.S., I needed to get in here because if somebody has an idea of a startup, they should be doing this. In the U.S., it's similar to in Peru. Healthcare is a thing that a lot of people just don't have, and they don't want to spend the money for it. And yet everybody buys a lottery ticket. So my father actually ran a company in Peru for a few years where he It was a weekly lottery ticket that came with an insurance policy attached to it, a healthcare policy attached to it. And so he was deliberately giving everybody health insurance while also gambling on trying to win that lottery. Right? It's just a brilliant idea, and it was an instant success. And the other thing, superannuation in Peru is the same thing. Nobody's saving in Peru, right? Everybody has their house, and then the rest of it they're spending it, being forced to save. And one of the key things is to give enough freedoms. It's not just about you have 5 risk portfolios. You have 5 different providers that the government has approved to provide you 5 risk portfolios. So there's that kind of illusion of choice, and they all pretend to kind of compete against each other, and they're slightly different, but there is some choice there. So I think the success here of the school is to really couple that education with the right incentives, as Meb has said. And there's tons. We know much more now on the behavioral side than we ever did, and we're not using the tools as well as we should.
I think there's
Rod
less
for Prime
consensus
Minister.
on the actual messages that we should be teaching. That's the other thing. Like, as everyone was sort of saying, well, the inverted pyramid and whatever. I'm like, I don't know that there's any more consensus on what the right savings and investment plan is for everybody, as there is on, the optimal food pyramid. So there's that issue.
Save something.
Well, it works for real estate. I think most people can identify with that. Real estate is not a huge wealth builder because it's a magical asset class. It's fine. It's because it's forced savings you would otherwise spend. We all hedonically adapt, right? If you got money laying around, like most people are gonna spend it. Real estate, they get like it's a house, it's a home, it's forced savings every month. It's just a little harder when it applies to everything. But you talk to anybody in Australia about their supers, they love them. They're like, this is amazing. This is great.
No, we're big fans too. Yeah.
Cool. Well, that's 90 minutes. You guys want to do another 90?
This is maybe want to drink. That maybe this podcast, instead of drinking throughout, it's like drives you to drink.
Yeah,
that was the ultimate goal. That's why we insist on drinking throughout, so that by the end you're sated.
You're loosened up.
Exactly. Yeah.
I have a whole bullet point list of things to talk to rise up the crew. We didn't even get to them, so I have to do it again.
Well, hit them.
One thing I do want to ask:
not.
Did you say that you have the URL risk parody, like?
Mm-hmm.
As in the, I want
Not
that.
parity or
make an offer.
You have that. You have risk
I
parity.
do.
Oh my god.
And
Okay.
I used to have
Real
risk parity.
parody. Love it. I love it. I might take you up on that.
That's awesome.
We'll submit a private offer on a napkin.
Of course. Well,
Awesome.
What do you think, guys? That's that then.
Yeah.
Yeah. Well,
Listen,
happy
Thanksgiving,
Thanksgiving,
Matt.
It was
Thanksgiving,
fun.
everyone else.
I hope all of you take a at least minimally effective vaccine and get to come see me in Los Angeles shortly and hang out, and hopefully get to join you guys back in the cold north, either for some turns or
you got to come
whatever
to
that
Cayman.
Thai place was. I want to go back just for that Thai restaurant. I hope they haven't gone out of business.
Yeah,
Please tell me they
super Thai.
haven't.
Pie.
They're pie. They're still there.
Oh,
My
is it
daughter
pie?
lives. My daughter lives a block from there, so they're
They're
still
opening
operating.
a second one up in Davisville. Yeah.
So there you go. Free restaurant recommendation. PAI, Pie. If you go to Toronto and you like Thai food, that is the place to go. Best place.
That is the box.
Yeah.
And the
Agreed.
March for the Fallen. Maybe next year it's back on.
That's right.
Yeah. We did one here local in LA this year remotely. So I think 2021. I think everything's moving the right direction. I'm optimistic. I always sound like a pessimist, but at my core, I'm a big optimist.
I always feel like you sound like such an optimist, actually.
Oh, good. Thank
Because
you.
everything's relative.
I'm passing the recording along to my family and
Perspective.
friends. Yeah.
Perspective. Yeah.
Yeah,
Love it.
That's right. All right. Well, thanks.
All right,
Happy
gentlemen.
Thanksgiving, everybody.
Happy
and,
Thanksgiving. Yeah. Thanks.
We'll see you next
Cheers.
time.
Later on.
Bye, guys.